Yo, what is going on, guys? A lot going on this morning, a lot to go through. So we're just going to walk through the setup that is developing right now, kind of recap what happened yesterday, and then go through what I am looking to do moving forward and how I'm going to act on it. So first, let's just take a look just to give you an idea of what I'm looking at here. If we take it to our top overbought and oversold signals list, this is probably the most overbought bearish trend signals that I have seen in a while. So there's over 130 tickers. And these dashboards track all of our global macro exposures, so a bunch of sector ETFs as well as individual names within those sectors. So the reason there's so many overbought signals is because of the nature of this rally that we're going to get into in a little bit here. But a lot of them are individual names. At the top of the list you have MicroStrategy, the Block ETF, Coinbase, a lot of those crypto exposures. Crypto had a big day yesterday. It's still kind of continuing that move up a little bit here this morning. Stocks have since then turned a little bit to the downside. They're flat to up right now in the pre-market. But let's shift over to our US equities dashboard. So yesterday what we mentioned is during these bear market rallies, it's very common that you see flips in positive short-term momentum. So this is all based on our momentum and trend signal that is from TradingView that I'm sure many of you guys have seen. And what we have is that most sectors did pick up positive price momentum, but still they remain bearish on our trend signal. And those shorter term shifts in momentum don't change the longer term trends. And on top of that, a lot of these sectors are starting to signal overbought as they close in on the top end of their volatility range. So going back to what I said earlier about how and why there's really so many names on that overbought list was really because of what is happening, in the market during this squeeze. So looking in this middle column here, you'll see the volumes. This is where we compare all the volume relative to the 5-day average, the 1 month, and the 3 month. This kind of just gives us a better idea of how strong or weak the volume is on up and down days. So yesterday, we had a huge move to the upside, plus 2, 3, even 4% across the board in sector ETFs. So those are huge moves, right? Individual stocks were up 10, 15, 20% in like MicroStrategy or Coinbase's case. But what we saw was a major deceleration in volume relative to these 1 month averages. So what you want to see as a bull is you want to see that volume start to increase on the way up, because that signal strength shows that investors are actually starting to come back in size. But now, since we have all of this volume decelerating on the way up, that does signal more that it's more of a short squeeze and that people are covering shorts and not really coming back into the long side in size. And just to narrow it down a little more, if we look at our retail dashboard, these are a lot of names that were getting squeezed. You can see all the overbought signals that we're starting to get here. These are the names that, people should be short in this environment. If we're heading into what could be a recession, just really any bear market, you do not want to be owning retail stocks. And obviously big money hedge funds know that. So when they all go short them, yeah, it's a good trade to go short a lot of these names. But you obviously can't be short at every single price and at every single point in time, because that once everybody starts to pile in on the short side, the probability of a short squeeze starts to rise. And that's what we're going to get into right here, just to show you a bigger picture, kind of look at the S&P, NASDAQ, and the Russell from a positioning perspective to show you how short everybody was coming into this rally. This is what I mentioned on Instagram and TikTok a couple days ago, just kind of going through how we had all these negative catalysts lined up, right? We had the Fed coming out, we had inflation reports, earnings are starting, so investors naturally got net short the market. And you might be wondering, why is net short positioning actually bullish in the short term? And mainly for two reasons. For the first one, as I just said with the retail example, once everyone is already short, the process of them getting short and starting to sell is not bullish. But once they're already short, then the probability of a short squeeze starts to rise. And the second reason is that it's a lot harder to drive the market lower when everyone is already positioned for a turn to the downside. Right? So you don't have that size that can come in on top of that and kind of fuel that move down, because people are already short. That's the positioning they already have on. So if you do get a big move to the downside, you're likely going to start to see people covering, and then that will increase the buy pressure and help move the markets back up. So I wanted to walk through this chart, and there's a lot of numbers here. It might look a little bit confusing, but we're just going to pay attention to the top box here. So if we look at SPX, this shows CFD futures, futures and options positioning. So latest, the S&P at net short position of 165,573 contracts. So that is that is for the S&P, just SPX in general. And if you want to compare that to how it's been over the past year, you could look at the 1 year average is a net long of 72,000 contracts. So huge spread there. Then if you want to take it one step further, if you look at the far right far right column over here with the z-score. So you look at a 1-year z-score. Now this puts it in standard deviation terms, so it's a 2.76 standard deviation move. Now the way to read this is anything greater than or less than a 2 standard deviation move is considered extreme. So this gives you the positioning relative to itself over the past year, so it's definitely an extreme net short positioning. Yes, if you look down and you see the NASDAQ, they have a 28,193 net long contracts. Pretty big position on the long side, but just the S&P, that's a pretty big short position. And on top of that, going back to the short squeeze, if you look at the Russell, that also has a massive net short position of 120,000 contracts, and that puts it at a 2.73 standard deviation move to the downside there. So that's definitely an extreme net short positioning as investors were bracing for the upcoming catalyst that we had. But even when you have all these catalysts, the catalyst that sticks, after that happens, after the inflation reports come out, after companies start to report earnings, is the positioning, because positioning will have to unwind after those events. So when you have everyone short into those, the probability of a move higher starts to rise. So that's what I think is going on here in the market. Obviously it could change, but that is just based on positioning. So now let's go in and let's take a look. Yesterday I mentioned how the dollar was probably one of the most important signals to watch in all of global macro. We bounced right off the low end, or pretty close to the low end of the volatility range here, up around 0.21% this morning. So this is if the dollar does start to strengthen here, and this is how you already start to see stocks turn to the downside in the pre-market. If we start to see the dollar strengthen, given the inverse correlations between the dollar and the S&P and the crypto and commodities, whatever, it's highly likely that you'll start to see that pressure come back to equities if we start to see the dollar rise. So that's kind of just how those two go hand in hand there. Guess we could go through what I did. So if we look at my trading section here, I was shorting, we had HCO, that's a retail stock that we mentioned yesterday. On top of that, in the morning, I also started to buy some inverse Russell short. So this is something, if you don't want to just short, stock straight up, if you're running like a long only account, a way that investors like to play that downside is buying these inverse ETFs. They're not great to hold over the long term, but if you're just, trying to trade around it within a shorter time frame, they're all right to use. So I was starting to buy some TZA, that's the inverse Russell ETF. We take it back up over here to look at our IWM chart. IWM was pretty close to the top end of its volatility range within its bearish trend. Yes, it picked up positive price momentum, but still looking at all the other signals that we have here, volume was down versus the 5-day, the 1-month, and the 3-month averages. The accuracy of this signal, we back tested it with all the available data on TradingView. So that's over 22 years worth of data, 93.1% accuracy. So that's a good spot. That's where we were starting to add there. The S&P, I wouldn't short the S&P, even though it is pretty close to the top end of its volatility range here. The reason for that is because obviously the S&P has everything in it. So it actually has components. It has utilities, it has consumer staples, REITs, and those are generally sectors that work well in bear markets. So, I don't want to be shorting those, but I definitely am interested in coming back to the short side of tech. If we look at XLK here, pretty close, right up towards the top end of its range. It has 0.1% upside. This will adjust as soon as the market opens, and I'll be giving those real-time updates to our premium subscribers. But as of right now, as of yesterday's close, that's what we have for the setup. That's basically it. Still sticking with those individual retail shorts. Definitely looking to come back to the short side of tech. I was also adding to my long vol position. So the VIX, kind of went out towards the low end of its volatility, the vol of vol range here. So I was adding to that, adding to my VIXM and the VIXY that we went through yesterday. But yeah, I think that's it. That's kind of what I'm going through. That's what I'm seeing in the market. I mainly wanted to just kind of explain the setup and how this net short positioning will impact the market in the short term. It doesn't change any of these longer term trends. So that's what I'll be paying attention to. If most of these aren't even close to flipping over from a trend perspective back into a bullish regime. But today we also have, I think we have VIX OPEX. So you might have heard the term OPEX flying around, options expiration. So generally around these dates, that's another catalyst where investors are going to have to rebalance their books. So given if they're long and short positions, they're going to have to trade around that with their, I don't know if they have positions on in volatility itself, but generally you'll see dealers suppress vol and buy stocks into these moves as investors are rebalancing. And that'll end today. So, interesting setup where we have some catalysts lined up. We do also have a Fed meeting towards the end of the month, so next week. That's going to be big, but we'll keep you updated with everything that we see on a daily basis here. As always, if you guys do want more updates, check out the links down in the description. That's where we have our premium memberships. And if you want to receive all of these global macro dashboards, all the refresh dashboards, overbought and oversold signals every day, as well as have access to our trading algorithm here on TradingView. Check out the premium membership section there. Shoot me a DM if you ever have any questions, and I'll catch you guys back here tomorrow morning. Peace.